Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're focusing on Duke Energy Corporation, one of the largest electric power holding companies in the United States. Duke Energy is known for providing electricity and natural gas to millions of customers, as well as for its investments in renewable energy. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's get started.
Duke Energy has been a major player in the energy industry for years. From a behavioral finance perspective, how do biases like the status quo bias and loss aversion influence their decision-making, especially in areas like energy production and infrastructure investment?
The status quo bias is particularly relevant to Duke Energy's approach, especially in how they manage their energy production and infrastructure investments. In the energy industry, both companies and customers often prefer to stick with established energy sources and infrastructure due to the perceived reliability and lower risk. Duke Energy leverages this bias by maintaining a strong focus on traditional energy sources like coal, natural gas, and nuclear power while gradually integrating renewable energy into their portfolio. This approach allows them to offer reliable energy services while also positioning themselves to adapt to future energy demands. Loss aversion also plays a significant role, particularly in how Duke Energy approaches risk management and investment decisions. Loss aversion refers to the tendency for people to prefer avoiding losses rather than acquiring equivalent gains. In the context of energy production, Duke Energy might prioritize investments in proven technologies and infrastructure to minimize the risk of financial loss or energy supply disruptions. This bias can lead to a more conservative approach in adopting new technologies or shifting entirely to renewable energy as the company seeks to protect its existing assets and revenue streams.
And this focus on leveraging the status quo bias and loss aversion has helped Duke Energy maintain its leadership position in the energy industry, appealing to both customers and investors who value stability and reliability.
Exactly. Duke Energy's strategic use of the status quo bias in maintaining traditional energy sources and loss aversion in managing investment risks appeals to investors looking for a company that balances stability with gradual innovation. However, this approach also means that Duke Energy must carefully manage the risks associated with changing energy regulations and the growing demand and for renewable energy, particularly as the energy landscape continues to evolve with increasing emphasis on sustainability and carbon reduction.
Let's talk about diversity, equity, and inclusion at Duke Energy. As a major player in the energy industry, DEI is particularly important for Duke Energy. How does this intersect with behavioral finance?
Duke Energy's approach to DEI is crucial, especially as the company operates in a global and highly regulated industry where diverse perspectives can drive better decision-making, operational efficiency, and innovation. From a behavioral finance perspective, strong DEI initiatives can enhance Duke Energy's ability to innovate and adapt by fostering a culture that values diversity and inclusion. A commitment to DEI allows Duke Energy to attract and retain top talent from various backgrounds, which is essential for maintaining its competitive edge in the energy industry. For investors, Duke Energy's focus on DEI can signal that the company is socially responsible and aligned with modern societal values, which can enhance its reputation and appeal to ESG-focused investors. Additionally, DEI efforts can help Duke Energy build stronger relationships with employees, customers, and communities, reinforcing its brand as one that values inclusivity and ethical leadership.
Investors are increasingly considering DEI when evaluating companies, especially in industries like energy, where the ability to foster inclusivity and sustainability is critical to long-term success.
That's right. By embedding DEI into their corporate culture and operational strategies, Duke Energy not only improves its ability to serve a broad range of stakeholders but also strengthens its market position and attractiveness to socially conscious investors.
Moving on to market adaptation, Duke Energy operates in a highly regulated and environmentally focused industry. How does the company adapt to changing regulations and energy demands, and what role does behavioral finance play in this?
Duke Energy's strategy involves continuously adapting its energy production and infrastructure investments to meet the evolving regulatory and environmental standards while maintaining its focus on reliability and customer satisfaction. From a behavioral finance perspective, this adaptability is crucial for managing the risks associated with regulatory changes and shifting consumer preferences. Duke Energy's ability to understand and respond to new regulations such as those related to carbon emissions, renewable energy mandates, and energy efficiency allows it to stay compliant and competitive. By proactively investing in renewable energy and sustainable practices, Duke Energy can mitigate risks and capitalize on opportunities in the growing market for clean energy.
And this adaptability is essential for Duke Energy, especially as they face competition from other energy providers and increasing pressure from environmental regulations. Their ability to maintain their brand's relevance and leadership in a changing industry is key to their continued success. Exactly. Duke Energy's focus on understanding regulatory environments and adapting its strategies accordingly allows them to remain a dominant player in the energy industry while staying ahead of emerging trends and challenges. However, this also requires them to be proactive in responding to changes in energy policies, consumer expectations, and technological advancements. Now, let's compare Duke Energy to other companies in the energy and utility sectors like Southern Company, NextEra Energy, and Dominion Energy. How do the behavioral finance dynamics differ?
Duke Energy's dynamics are often compared to other energy giants like Southern Company, NextEra Energy, and Dominion Energy, particularly in their approach to energy production, infrastructure investment, and competition. Duke Energy's strength lies in its focus on traditional energy sources and its gradual integration of renewables, appealing to investors looking for a company that balances reliability with a cautious approach to innovation. Southern Company, with its emphasis on natural gas and nuclear power, appeals to investors interested in a company that prioritizes energy security and reliability. NextEra Energy, known for its leadership in renewable energy, attracts those looking for a company that is driving advancements in clean energy and sustainability. Dominion Energy, with its focus on natural gas and electric utility operations, appeals to investors interested in companies that integrate diverse energy sources and services. Duke Energy's behavioral finance dynamics are shaped by its reputation for reliability, strong market presence, and adaptability, making it an attractive option for those seeking stability and growth in the energy industry.
And unlike NextEra Energy, which focuses heavily on renewable energy and sustainability, Duke Energy's strength lies in its comprehensive energy services and commitment to reliability, appealing to a different type of investor and market.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value and potential risks. For Duke Energy, the focus on reliability, customer satisfaction, and market adaptability provides a unique value proposition in the energy industry.
To sum up, Duke Energy's approach to business is deeply influenced by behavioral finance principles, whether it's through their energy production strategies, adaptation to regulatory changes, or their approach to DEI. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives Duke Energy's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.